Hello and welcome to everyone. My name is Preetham Chivukula. I represent CREDAI-MCHI. Good evening to everyone and all my co-panelists. Uh, our president is currently predisposed, so I am filling in for him. Uh, Thank you everyone from the entire nation who have taken time out to join this session, which promises to be a very invigorating session on a very important topic like GST. GST is overarching and is really important to the profitability of our business. The compliances are becoming more and more. So it's very important that our builder members understand this very clearly. There has been a lot of water under the bridge over the last few years. And we thought it was very important that someone like ELP, which is one of the best consultants in the country, take this opportunity to present what is happening in the GST world and how it is affecting us. What I'll be doing is I'll be handing over the mic to Sunny Bijlani, who is also a co-committee member with me at CREDAI-MCHI and is an expert on GST matters. He will introduce the panel and the company which is going to present today and take the proceedings forward towards the end. Thank you everyone for joining in and taking your time out. I hope it's a very fruitful session for all of you. We look forward to your feedback at the end of the session. Over to you, Sunny. Thank you so much.
Thanks a lot, Preetham. I'd just like to make one small correction. I'm not an expert on GST, but I work with a lot of experts on GST. So it's great to see such a large turnout, and it also proves what a big pain point GST has become in our everyday lives. So just to cut to the chase, we have ELP, and we have the three main partners of ELP who are with us, who've taken time out to present the entire topic and subject of GST, which is ever so complex. So we have Rohit Jain with us, Harsh Shah, and Gaurav Sogani. They, with three of them and ELP, CREDAI-MCHI has an existing consulting engagement, and they've been part of all the representations we've made to various government bodies. We've even had them present with us for in-person meetings with the Finance Minister Maharashtra, with the Principal Commissioner GST, and literally every letter that goes out on GST from CREDAI-MCHI has their eyeballs on it. So we have a very, very good partnership going on with these guys. I'm not going to waste too much time. Just before I hand over to ELP to take the presentation forward, just one request to everybody. We all, I know, have a lot of questions. Their presentation, I believe, is quite exhaustive. Most of the questions, I think, would be answered in the presentation. However, after the presentation, if there are any questions, all of you all will be given a time slot to put your questions in the chat box, and then ELP can take one question after the other. So thanks a lot once again, and over to ELP, Rohit, Harsh, and Gaurav. Thank you.
Thank you, Preetham. Thank you, Sunny, and thank you, CREDAI-MCHI, for inviting us to speak on such an important topic. When we started with, when Sunny called us and he said, Rohit, can we do a session on the GST on various development models that we have got, and Preetham and all we discussed. And we thought, yes, let's start with, and maybe now it's been 2.5 years now, April 2019, the entire real estate GST scenario undergone change. And people are actually, aware of what is happening. And then we said, okay, never mind, let's get into the presentation, let's do something. And now we could see the registration, we could see the number of participants, and now it clearly makes worth to talk about this important topic for the sector. What we have put together are various GST implications under different models which have been used by the sector. We not only been associated with CREDAI-MCHI as a consultant handholding to these important initiatives for GST matters, but also we have been advising many of you in relation to the tax issues which are coming up, and completely aware of in terms of what could be the potential structured development models that we have got and how do we really address those. So I would request Gaurav to upload the presentation and straight just gets into the presentation. As Sunny said, we have covered a lot of thoughts, lot of models exist. We have got a lot of implications under different models. And therefore, I would request that we take it question and answer session at end of the presentation. And you would find in terms of many of those questions might got addressed in the course of the presentation itself. Therefore, you may not need to eventually ask that question. Okay, let's get to the straight into the, as we given the topic, what are the GST implications under the different development model that we really work at it. So let's talk about, largely if you look at it, there are 4 or 6 models which are working. When we actually buy the land, we develop that into a developed plot and sell those developed plots. Then we have a project on our own land. So we buy the land and we develop the project. Then we have lots of joint development arrangement, different nature of transactions, and we carry out joint development arrangements. Then particularly in cities like Mumbai and other metro cities, we have society redevelopment arrangements as well. We have SRA projects, and we have development manager model under which we really work at it. So different implications, different tax applicability qua GST, and we have put together all of these thoughts so that we understand all of this. At the same time, the project that we would effectively have could be a residential development project, it could be commercial development project, or it could be a mixed development. We would have a combination of residential plus commercial as a mixed development is what one would develop as a project when it comes to a development side and when we sell that development. Let's go to the first and foremost, and therefore let's get to the, we don't want to make it very elaborate on a text, but let's understand the tax position today, and such tax position then we will apply to the transaction in question. The first and foremost, what has been defined to mean a real estate or residential real estate project? A real estate project in which the carpet area of commercial apartment is not more than 15%. Now, therefore, the first criteria, first thing that one needs to really do it, categorize the project into a residential real estate project, or is it a real estate project per se, which is other than residential project. So in a area, total carpet area, if the total area is less than 15% being a commercial area, it is qualified being an RREP. If anything more than 15%, then it is qualified being an REP. Because this is something which is very important, because that is how effectively the rate of tax is changes depending upon whether it is RREP or REP. If it's an RREP, even for the commercial units, the rate of GST is 5%. If it's an REP, the rate of GST when I sell the commercial units becomes 12%. We will talk that in detail about the rate and the credit availability and all of this. But the first concept that we need to start with, that what is the REP and what is the RREP. Now, the first thing that comes up as an issue which starts from here itself, that what do I define when I calculate this 15%? Now, under RERA, we all know that we can take a separate registration. So in a building or in a project which I am developing has assuming of 4 towers, I can take first 2 towers a separate registration and second 2 towers as a separate registration. How do I calculate this 15% as an area? The first and a very conservative view and very simple proposition is that whatever I have registered as per RERA should be considered for calculation of this 15%. But is that the correct understanding in terms of the legal interpretation? May not be, because if you see the definition of real estate project, go back to earlier slide, Gaurav, where you would find that real estate project meaning assigned in clause ZN of section 2 of RERA. And what does section 2ZN of RERA suggest? Section 2ZN of RERA suggests that means the development of a building or a building consisting of apartments, converting an existing building or part thereof, development of land into plots and all of this. It does not talk about anything qua registration. Therefore, one interpretation which is possible, that whatever I have signed this as a project for the purpose of layout, when I take the approval from the corporation, when I go and market this as one project, then one may look at it that entire project as one real estate project as opposed to each RERA registration being a separate project. So therefore, the first issue of interpretation really comes up here, that what do you mean by real estate project? Is it the project which I have actually taken put the layout? Is it a project that I have actually taken an approval from the government? Is it a project where I have used my entire FSI across different buildings? And that should be ideally considered as a project, because that is how you have actually acted upon for every aspect of it. Only for the purpose of RERA, you are defining separate building as a different project does not mean that that is the real estate project for the purpose of definition. So the first thing that one should start looking at it, that this 15% which I need to calculate as part of a total area, how do I define this real estate project? And it is possible to take the entire project as one project as opposed to as per the RERA registration. So that's a one important issue that one needs to really understand. The second one, go back to earlier slide. The second concept here is a real estate project means a development, go down, development of a building or a building consisting of apartments, consisting of existing building or part thereof, or the development of land into plots or apartments. Now, this is very important because when we talk about the first leg of a development where I'm developing a plot and selling a developed plot, can I say that it is really a service at all for the purpose of GST? And therefore, please keep this word in mind that real estate project would mean development of land into plots. And if I'm selling that, that would also be considered as real estate project for the purpose of RERA. And once it is a real estate project for the purpose of RERA, it is a real estate project for the purpose of GST as well. So keep that correlation in mind, that development of land into plots would also be considered as a real estate project. Okay, now move on to the next slide. What is the treatment that one needs to give for a transfer of development rights? Now, all those good arguments that development rights is nothing but an immovable property. These are rights arising out of land. These are effectively transactions should not be therefore liable to GST, because what is payable under the GST is goods or services. How can somebody tax which is an immovable property? I think all of these arguments are good to have. We have filed some writ petitions. We are awaiting the outcome of writ petition. Let's analyze the position as it stands today. And as it stands today, the development rights in the transfer of development rights is considered to be a transaction in service. And but for exemption, there will be a GST payable in case of a transfer of development rights. Now, there have been one exemption granted effective 1st April 2019. And it's very important to analyze this exemption, which is exemption is available for transfer of development rights or upfront premium for long-term lease of 30 years or more, subject to fulfillment of following conditions. One, the same is transferred on or after 1st April 2019. Second, it is used for the construction of residential apartments by a promoter. And third, apartments in the project are intended for sale to a buyer, whether wholly or partly. Now let's take it step at a time. Okay, this is the important exemption which matters in every development that we really do. The first one, that if there is a transfer of development rights, then that is exempted subject to three conditions. That such transfer is on or after 1st April 2019. Second, it is used for the construction of residential apartment and apartments are for sale. Let's examine all the three conditions and different nature of transaction. Focus on this exemption because this is the crux of the entire discussion that we are going to have today. The first and foremost, there needs to be transfer of development rights. Now, how do we decide the transfer of development rights? We all enter into a JDA, which talks about that they hereby we are giving you a development rights for the purpose of development of this effectively the project. So the transfer of development rights has to be on or after April 1st, 2019. Now we have a lot of issues coming up in terms of this very first condition itself. And let me take up all of these different issues which may come up there. First, I have signed a JDA prior to 1st April 2019. but I am making the payment post 1st April 2019, am I exempt? Now the question comes in, you have transferred pre-April 2019, but now you are actually effectively making payment of revenue share or area share. Can you say this is transferred after 1st April 2019? Answer may be no, because what is your language in the agreement says? If the language of the agreements of a development agreement says that we hereby transfer all the development rights, that means you have transferred prior to 1st April 2019, and this exemption may not be available. The second one, which is most important, it is not, we have seen multiple transactions where it is not that the entire FSI which is available in the land, it is transferred. Even what you need to buy from TDR or what you need to pay as premium, the landowner undertakes to buy after the JDA and then transfer to the developer. Now what happens in those cases? You don't have, as on the date of signing of DR, development rights agreement, or a JDA, you don't have that FSI available. You will have to take the steps by making the premium to the corporation. You need to take the steps by buying the TDR from the market. All of those steps you may take after 1st April 2019. Therefore, to that extent, the TDR and the FSI, additional FSI that you get, will get transferred after 1st April 2019. So the first and the foremost issue is that the language of the JDA decides on which date the DDR or the development rights got transferred from the landowner to the developer. And therefore, it is very important to analyze the language in the agreement, that how is that been worded today. The second condition, it is used for the construction of residential apartments by a promoter. So the first and foremost, it is used for the residential apartments by a promoter. What happens in a transaction where it is done by the traders, where one guy is buying the TDR and in turn selling the TDR to the promoter? What would happen in those cases? We have a cases where the trader in between entity who may not be a promoter, and if he is not the promoter, the issue really comes up that whether this exemption is available, may not be available. So on the first leg there is a tax, on the second leg there is no tax, and then the entire chain game may get broken up. Therefore, one needs to examine that when the TDR is effectively bought from a trader, is this satisfying the condition that it is by a promoter as such, as a residential apartment. So that's a second aspect which one needs to be clearly looking at it. Third, apartments in the project are intended for sale to a buyer, whether wholly or partly. Now, what does it mean? That if I am doing something on my own, I am effectively constructing a building on my own, and then I am effectively not intending to sell, and I am giving this for the purpose of commercial, apartment, which is anyway not getting covered in two. But even if I am doing something, a residential apartment, which I am not planning to sell pre-OC, and I'm planning constructing and I will sell post-OC, still that exemption won't be available, and there will be a GST which will be applicable under reverse charge mechanism. So if you look at it, all of these three conditions are minutely need to be examined and to be applied for, that what date is the date on which there is a transfer of development rights. Is it pre or after 1st April 2019? It is used for construction of residential apartments, and whether such project is intended for a buyer to be sold whether wholly or partly. Now, another important concept which we need to be really worried in this particular language itself. Go back, Gaurav. The first one is, it is not only for development rights, we also have an upfront premium for long-term lease of 30 years. We have seen many clients who are taking the SIDCO land, who is taking MIDC land, who is taking some Industrial Development Corporation land, on which it is not a transfer of land per se. What do we get? We get the rights for that land, and those rights are in turn assigned from party to party. What will happen in those cases? These are all industrial plots. These are all maybe a SIDCO residential plots where the owner is the government entity. The owner is the governmental undertaking. They don't transfer this particular land per se. What do? They transfer the rights for that land, and those rights, leasehold rights, then get to us, and then that party gets transferred to the other. Ultimately, it reaches to a developer. In that case, given the language of the notification today, it's only upfront premium for long-term lease for 30 years. It is exempt, but all other assignment of a lease, whenever there is an assignment of a lease, there will be a GST payable, and it will become absolutely problematic for a developer, because on that leasehold land, if we are developing a residential project, and if I would be going and paying 5% GST, while I end up paying on leasehold lands, there may be a GST applicable, but in turn, I am not entitled for that as a credit. So believe us that these issues have been taken up already. We will take you through that, but already we need to be extra careful that when we are doing a project on a leasehold land, there are different GST implications that we need to examine. One issue comes up, oh, already these are assignment of leasehold rights for 99 years. Good, 99 years may be a transfer for the purpose of Stamp Act. 99 years may be a transfer for the purpose of income tax. 99 years may be considered as a transfer for the Transfer of Property Act, but not for the purpose of GST, because GST treats this only as a transfer of title, as a sale, being a sale of land. All other transactions have not been considered as a sale of land, and therefore we need to be extra careful that whenever we do the project on a leasehold land, the GST issues is coming up very differently, and it is becoming unviable really, because you end up paying 18% GST with no corresponding credit being available if you are doing a residential development. So be extra careful when the project is being developed on a leasehold land that we have got here. Moving on to the next slide. What is the other important explanations to the notification? One explanation is 1A, and the second explanation is 1B. And that explanation particularly applicable in first one in the case of area share, where the similar flat is given nearest to the date of transfer, that is transfer of development rights into the development rights per square feet, is the value for the purpose of area. That means whenever I enter into a JDA in the form of area share, and I give the area in the form of consideration for getting the development rights, value is required to be taken as per the similar flat value for the purpose of GST payment, and you would apply that GST value. Very problematic, another provision. And the second problematic provision is 1B, where value portion of a residential or commercial apartments remaining unbooked on the date of issuance of completion certificate, you will apply similar flat value into area remain unsold for the purpose of calculation of this 5% and whichever is higher. We will talk about that as an impact. Sorry, at a management committee, there is at a, okay, sorry, go down next. You will have the impact that we need to really deal with. One important question again, we don't want to deliberate more on this, which is para 2 here, that if I am doing a project on a leasehold land, can I get a deduction qua land? So assuming for a moment, I am doing a leasehold land project and I'm selling the apartments. I am doing a conveyance of the apartment and I'm doing a conveyance for a 1 crore rupees of a flat. Can I take a deduction from 18% and only pay 12%? Because the land is not getting transferred, land is only getting assigned to the society. In that case, the important term here is total amount, means the sum total of consideration charge for the aforesaid services and amount charged for transfer of land or undivided share of land, as the case may be, including by way of a lease or sublease. So very important term here, that even if the land is getting transferred by way of a lease or sublease, you will be able to claim the land deduction and pay entirely only 12% tax. Or in case of a residential apartments, instead of paying 7.5%, you could end up paying 5% tax on that, even if you are developing a project on a land which is a leasehold land and not the ownership land. So very important. that you need to keep this in mind is the provisions. Going down to the next slide. Another and the most important recent amendment is the time of supply. This amendment is effectively been done 2 days back, where they have amended the language at what point in time there is a GST payable. So let me take it this quickly also, where promoter who receives the development rights or long-term lease after 1st April 2019 for construction of a project against consideration payable or paid by him wholly or partly in the form of construction services, including in the cash, shall pay GST on the consideration paid by him in the form of construction and the monetary consideration. So effectively, if you are giving an area share, and when you are giving an area share, at what point in time you would pay the GST? And there they have made it now clear that you can pay a GST in a tax period not later than the tax period in which the date of issuance of completion certificate for the project. That means in a case of an area share, if a landowner is giving the development rights, promoter is in turn giving the area. If you would have paid on the area GST at the time of completion, by the time that landowner would have sold that flat to their customers, then this 5% was becoming an issue and a cost. To address that scenario, they have made an amendment where in a tax period, not later than the tax period in which the issuance of CC happens. That means you have an option to make the payment pre that tax period. That means as soon as you start building up the construction, you can start paying. In fact, you can pay when your landlord in turn selling the flat to the customer. You can also charge as a promoter to the landowner GST. He can avail that 5% as a credit and in turn charge 5% to their customers. This is a welcome amendment in the context of recent development that you can effectively pay the GST before the completion certificate in terms of this language, and therefore this is a facility or this is a good development that we have happened so that it does not become a cost in the hands of landowner eventually. Okay, so this is time of supply. Now come to the various transactions that we carry out and what are the implications of all of these transactions, right? And let's examine all of these. First is a sale of a plot. So there is a landowner. What are we doing? We are developing the plot. We are developing the plot where we are putting all sort of infrastructure, the roads, the streets, street lights, the drainage system, the water tank, whatever. So we are developing the entire infrastructure. And after development of this infrastructure, we will be selling those plots to customer, which is a developed plot. You would ask, what are you talking all of this? Why are you really speaking? It is nothing but a sale of land. Ultimately, developed plot is also a land. And if it is a sale of a land, why are you really bothered about talking the GST implications? I would put it, yes. According to us also, it could be considered as sale of land. And therefore, ideally, it may not be liable to GST. However, recently, we have got the two advanced ruling authorities in case of a Dipesh Anil Kumar and Abhishek Darak Kach. And in those rulings, what has been held that the sale of a land after the development is not as is where is basis, and therefore it is liable to GST. Now let's take a look at this in that context. When I'm developing a plot of a land and selling the land per se, the advanced ruling authorities have said it is liable to GST. Now, one of the judgment, which is Dipesh Anil Kumar, have relied upon a Supreme Court ruling, and they have said that Supreme Court in that ruling has held in the context of Consumer Protection Act, has held that it is a transaction of a service and therefore consumer has a right to have claim under the Consumer Protection Act against the developer who is developing that land. And the Supreme Court was examining in that case the issues under the Consumer Protection Act. Now there it has held that develop of a plot of a land and sale thereof is a transaction in service. Now, if that be the logic, and that has been applied even for the purpose of GST, I think one should have applied the GST definition and particularly Schedule 3, which specifically excludes the transfer of land, which is a sale of land from a levy of GST. Now, another complication which comes up is that we have seen the definition of project under the RERA, and definition of project under RERA specifically includes sale of a developed plot. And all of us are now need to take the registration under RERA for the purpose of selling this developed plot if you are selling prior to completion. Now, the another issue comes up. There is nothing called completion as such, because many of the states do not issue the completion certificate of a developed plots. So what do I really do in that case? Then there we have a language of sale after the first occupation. So there are a lot of interpretational issues which are already coming up, but we believe that given the way the rulings have been coming up, one needs to be careful about the sale of a developed plot with the development of infrastructure may get exposed to GST. Therefore, what is the GST applicable? The second issue comes up, is it a 12%? And the only entry which is relevant in this context, if at all GST is payable, the entry number 3IF, 1F, under para 2 of notification number 11/2017. Gaurav, can you go to the next entry, where it talks about construction of a complex building, civil structure or part thereof, including commercial apartments and residential apartments. So it is an including definition, construction of a complex building and civil structure or part thereof. Can we say that when I'm developing an infrastructure, is it a construction? Answer may be no. But the only entry which may be applicable appears to be relevant here is the 12% GST on the entire value. However, we believe that one needs to look at it very differently here. One needs to look at it in the context of what is the real development charges that I'm incurring. And if I can really structure a transaction where I charge development fee separately or with the other legal entity, so much the better, and I offer 18% GST, and the rest of the transaction is nothing but a sale of a land per se on a as is where is basis. Therefore, at least the exposure of the entire transaction value getting exposed to 12% can be avoided. But currently, as we speak today, across the states, across the country, many of the states authorities have taken a view that all the sale of developed plot are liable to GST at the rate of 12%. We need to be absolutely careful when we enter into this transaction. This could be the transaction on our sourcing side, or this could be transaction when I am developing as a developer and selling those developed plots. And we need to be very careful in this transaction as far as the sale of a developed plots is concerned. This is the first leg of a transaction we thought we should bring to your notice. And we believe that one needs to be really looking at a different structure, different sort of a planning, so that we don't carry on this huge exposure of 12% on the entire plot of land being taxed. We need to have a different models under which we avoid this exposure. But on a standalone basis, it may be possible that tax authorities will take an interpretation, and two has been taken. One is a Supreme Court ruling, which they have not examined the GST provisions, and the secondly, all these AR rulings, and thirdly, the definition of real estate project under RERA, which requires development of a plot considered to be REP. So all of these aspects are something negative that we need to really look at it, and we need to understand this. One of the consistent question comes up, is the GST payable after the development or not? It may not be payable, because once you develop and then sell after development entirely, then it may still take color as a sale of a land. And the infrastructure development is effectively nothing but a sale of a land per se. As part and parcel of that, I am selling the land. What would happen in that sort of a scenario? One needs to look at it, the substance of a transaction. We have a rulings in the case of Mahindra and Mahindra. We have a ruling in the case of recently Bombay High Court ruling, where in the context of trust, Babibao Manubai trust case, they have said the substance of a transaction, the nature of the transaction needs to be examined. And if we apply that sort of a ruling here, The substance of a transaction after development is nothing but a pure sale of a land, and therefore it should ideally not be liable. It should get into Schedule 3 and should get excluded. But again, how do we really effectively look at that? How do we really plan that? How do we really put it in the agreement becomes a very important role. And therefore, are we really developing this infrastructure prior to sale or after the sale is a very important aspect to really look at it. Moving on to the next important aspect, now a project which is to be developed on our own land. Now project which is to be developed on our own land, the first one could be a residential development. So I have a own land on which I am developing a project. Now I am a developer. I will buy goods which is at 18% or 28%. I would buy services which is at 18%. And I would buy a works contractor services which is could be 18% or 12%. And then I am developing a residential apartment. If it is not an affordable residential apartment, I would have to pay 5% GST. If it is an affordable residential apartment, I will have to pay 1% GST. But the fact of the matter is that all the GST that I have paid on sourcing, whether it's a goods, whether it's a services like a broker, all the marketing agents, all of these, architect, consulting engineer, everybody would tax us, pay us 18% GST. And that will not be available to us as a credit. And then we have works contract, which is again an 18 or 12% GST. Now on this slide itself, let's focus on one of the 2 or 3 important issues which typically come up when I develop a project on my own land. First one, what is the definition of affordable residential apartments? Now, affordable residential apartment, as far as the definition is there, it is 60 or 90 square meter, which is what defined here. A residential apartment in a project which commences on or after 1st April, carpet area not exceeding 60 square meter in metro and 90 square meter in non-metro, and for which the gross amount charged is not more than 45 lakhs. Very important definition, because this is something which has been provided that if you are doing a project in a metro and it's a 60 square meter and below 45 lakhs, then only it would be considered to be part of affordable housing. If it is not an affordable housing, then it is liable to 5% GST. Now, there is one important tweak to the definition, which is an apartment being constructed in an ongoing project under any of the earlier prescribed scheme. You may be entitled to treat this as an affordable housing itself. Go down earlier slide, Gaurav. So, if you are doing this under ongoing project, and an ongoing project, if you are part of any earlier scheme where you are effectively being treated as affordable apartments, then that will continue even after this 1st April 2019, and you are entitled to take 1% benefit. So let me clarify what does it mean. That if your project, this project has more than 50% of the area, this project has more than 50% of an area below 60 square meter, then all those apartments which are below 60 square meter are considered to be an affordable residential apartment as long as this project has started prior to 1st April 2019. That means it is an ongoing project. That means even if the rate of that flat you are charging above 45 lakhs rupees, but this is an ongoing project, and in a project more than 50% area is below 60 square meter, you can charge 1% to your customers, even though the value of flat is above 45 lakhs. This is only in case of an ongoing project. So keep this in mind, conditionality. It is only in case of an ongoing project. Now, if it is not an ongoing project, it is a new project. If it is a new project, then you are required to satisfy all the three conditions. One, that your area is below 60 square meter and non-metro 90 square meter, below 90, and your price also is below 45 lakhs, and it is started after 1st April 2019. So effectively, the most important is that whether this project is ongoing or whether this project is a new project will decide the rate of tax for the affordable residential apartments, and you could potentially take a benefit of this 1% even if the value is above 45 lakhs if it is an ongoing project. That is the one nuances we wanted to bring to your notice. The second important nuances that one needs to understand here is for this contractor side. Now, when it comes to a contractor, because we all know that this 18%, this 28% on cement, this 18%, this 18%, all of these are cost to us because I'm paying 5% or 1%. Now, how do I really optimize this tax is a very important aspect. One of the issue comes up, when do I can pay the 12% GST? Is it possible? Because if I can pay 12% GST, I would save straight 6% of a GST on my all contractor bill. Now, that 12% GST benefit is available only in case of a construction of an affordable residential apartments. Now, there are three entries which gives us the benefit of 12%. And I must tell you, all of these three entries are even today existing under the law, and they are applicable, and we have the settled law that whichever entry is more beneficial, the contractor or the assessee can avail the benefit of that. So which are the three entries which makes us to charge contractor side only 12% GST? The first, if the scheme is under PMAY. So these are only limited one. There are not much of a traction under PMAY. So this is one entry. The second entry is very important. Infrastructure status, where more than 50% of FSI is used towards apartment less than 60 square meter. So if I have a project and that project has more than 50%, area is less than 60 square meter, then this gets the status like an infrastructure status. And once this is an infrastructure status, we are entitled to charge 12% GST as a contractor to a developer only to the extent of all those apartments which are below 60 square meter. And here, kindly note, there is no condition of a 45 lakhs rupees as a cap. This is a simple entry that we need to really interpret. That means if we are developing a project where more than 50% of FSI is used for the apartments below 60 square meter, then all of those apartments, the contractor can charge only 12% GST as opposed to charging 18% GST, even though the value of flat is above 45 lakhs, because for the entry 35DA, there is no condition of 45 lakhs. So keep this in mind. This is only for those apartments which are below 60 square meter, irrespective of what is the value, your contractor can charge only 12%. Now the issue really comes up, how do I award a contract for apartment which has both above and below 60 square meter? That is all the contracting. That is all you need to nicely structure it right. But there is an option to pay 12% GST in respect of all those apartments which are below 60 square meter, even though the value is more than 45 lakhs. For the contractor, as long as the 50% of the area is more than below 60 square meter. So this is very important entry that we need to keep this in mind. Then we have entry 35A. Entry 35A, which is more than 50% of the FSI used for the apartment with size below 60 square meter and up to 45 lakhs, then under 35A, the entire project gets a 12% GST. Again, mind this, keep the note of this, that if in a project where I am constructing an apartment where more than 50% is below 60 square meter, below, and the value is also below 45 lakhs, then the entire project can get a 12% benefit from the contractor, even though the some of the apartments are above 60 square meter, even though there are charged above 40 lakhs, 45 lakhs. So important here that 5A is applicable for the project and 5DA is applicable for the apartments. Therefore, it is quite necessary that we need to start analyzing that in what are the scenarios where it is applicable to 18% and what are the scenarios where it is applicable to 12% GST, and really need to take the benefit of these various entries that we have got under the statute today, which are very important, relevant for the purpose of optimizing the tax that we have got. Moving on to the next slide now. And the next slide is the most important topic for discussion is in terms of joint development arrangement. Now we have JDA, which we enter regularly, where we have effectively a transaction where there is a landowner transfer of development rights to a developer. In turn, developer gives a non-monetary construction consideration in the form of constructed apartments. Also, in some cases, pays money consideration, monetary consideration in the form of revenue share. And that landowner, if it is constructed area, in turn sale of that apartments to customer. And this developer would either sell pre-OC sale or a post-OC sale in a normal JDA that is entered. So JDA could be of two types. JDA could be of a revenue share. JDA, it could be of an area share. And depending upon the nature of transaction, the tax treatment changes. Go to the next slide. Now let's talk about JDA of a residential development. Now, there are various questions which comes up, which is JDA of a residential developments. Transfer of development rights. First, whether the GST is applicable. As we have seen, it is an exemption subject to the flats being sold pre-OC. So whenever the landowner transfers the development rights to a promoter, there is no GST applicable as long as all the flats are sold pre-OC. If the flats are not sold pre-OC, then the GST rate is applicable at 18%, and responsibility to discharge GST is on developer under reverse charge mechanism, and a value will be of a similar apartment sold nearest to the date of transfer of development rights. That means there is a capping of a 5% or 1% of value of area remain unsold based on a market value on the date of OC. That means if to the extent of post-OC sale area, I have an option to pay 18% GST on the value of similar flats given to the landowner. Proportionate to that, I will calculate 18%, or I will calculate 5% of my OC post-OC sale, and whichever is higher, I will pay the tax. And the time of payment now is in a tax period not later than tax period in which OC is received, and the credit of that is not available because you are not paying GST on a post-OC sale flat, and that will become a cost. So the first cost which will come in the hands of developer is the GST applicable on signing of JDA as a transfer of development rights. That's the first transaction. The second one, area provided to landowner. When the area is provided to landowner, then applicability of GST is, there is a liability to GST. Rate of tax is either 5% or 1% when I give it to that. That is again, a developer is required to pay that under forward charge. Value will be of a similar flat sold nearest to date of transfer and in a tax period not later than the tax period in which OC is received, and that is available as a credit to a landowner when in turn he sells the flat to the customer, as long as they are selling this pre-OC. Now, very important, this is how the entire transaction will flow. There are few questions which is immediately then come up in relation to these transactions. First, how do I really optimize the tax? What are the avenues? Now, mark these words. Value of similar apartments sold nearest to date of transfer of DR, development rights. So the valuation is as per the value of apartments sold to the nearest date of transfer of DR, not on the date of OC. So whenever you sign the JDA and closer to the JDA, if you have sold the flats at a lower value, because that is how typically prior to development you sell those flats, and after the development you increase the rate of those flats. So the value is closer to the signing of a JDA. So whenever you sign the JDA, the value will be taken of closer to the sale of flat of that value, while the GST will be paid at the time of OC, but the value will be at the time of the signing of a JDA. So very important, all of you can look at it. What is the price that I'm selling the flat closest to the signing of a JDA? And that value will be taken as a basis for the transaction. So very important to understand what is the lowest or value which is closest to the signing of a JDA will decide the value for the purpose of GST implications. Go down next. Now we have taken one example, just an illustration. So assuming a total area is a 30,000 square feet, just a very high level. Area to be handed over to landowner is say 30%, so 9,000 square feet. Area to a developer is say 70%, which is 21,000 square feet. Cost of construction, assume it's 4,000 a square feet. Market value on a date of transfer is say, or date of transfer means when I sign the JDA, say 20,000. Market value on a date of OC, hopefully this becomes real in today's day and age. At least it should be increased 20% closer to the completion. So say 25,000 a square feet. Unsold area, which is remaining post OC, say 6,000, 20%. So this is the illustration. Keep these numbers in mind, because in next few slides or the examples, we will be only talking about these illustration, where 30,000 is a square feet total project area. 30% goes to landowner, 70% with the developer. Cost of construction is 4,000. Market value is say 20,000 on the JDA, 25,000 when I'm actually getting an OC, and 20% remaining unsold, which is post OC. What is the tax implication in this project? First, GST on construction cost, 30,000 into 4,000, 12 crore rupees, 18% of that comes to 2 crore 16 lakhs is the GST cost, because that is not available to us as a credit at all. Subject to, if we can plan, how can I reduce this 18% to 12%, depending upon the size of the project, depending upon how many of them below 60, 90 square meter will decide this. So one is the 2.16 crore rupees is the first GST impact. Second, GST units which will be handed over to landowner. So value of area, I am giving them 30%, so 9,000 square feet. On the date of JDA is 20,000. I don't need to take a 25,000 rate which is on the date of OC. It's a 20,000 into 18 crores. 5% of that is a 90 lakhs. Is the another GST impact that I have got, because we know that landowner will not take that as a cost. And if we charge the landowner and landowner in turn is selling those and in turn recovering his pre-OC, he is entitled to this 90 lakhs as a credit. Therefore, developer needs to keep it in mind that in landowner, if in turn selling this to the customer, then he should not take this cost. This should be charged to landowner, and in turn he can take this as an offset to charge against the sale to the end customer. So this is a 90 lakhs. Then GST on TDR which is a development rights, effectively not TDR really. So 9,000 into 20,000, 18 crores, 20% remaining unsold, therefore 3.6 crores into rate of GST, which is 18%, and therefore GST cost will be 0.65 lakhs on this, versus if you're 6,000 into 25,000, 15 crores, 5% of that, 75 lakhs, whichever is low. In this example, this is coming to be a low, which is 0.65 lakhs or crores. Therefore, the total GST will be 2.16 plus 0.90 plus 0.65. Total entire GST in this sort of a project is 3.71 crores. And now look at it. When the top line, which I am looking at it as a developer, 70,000 into average rate, even if you say 20,000, which is whatever 140, 40 crores or whatever that number, 70,000 into say 20,000, whatever that comes to. In that case, the 3.71 crore becomes a huge GST cost which is inbuilt. Here we are not considering what on that what is getting sold to the customer. On that I am charging 5% GST. That we are not talking here, because that will be charged to customer and recover from the customer. But out of this 30,000, sorry, I'll correct it, 30,000, 9,000 is going to the landowner. So 21,000 into 20,000. So out of 40 crore rupees of a sale, 3.71 crore is like almost a 9 to 10% is a GST cost on a development of a project under the JDA, which one needs to keep it in mind if these are the permutation and combination that we are really looking at it. Therefore, as a developer, one should have a back of the envelope calculation that 7 to 8% is nowadays becoming a cost of doing the project as part of a GST itself. And we all know that in some cases, this is like equal to the margin that we earn. Therefore, anything that we are doing as a planning, one needs to keep this in mind as a cost. And this is further gets enhanced if we are doing this project on a leasehold land. Leasehold land, there is additional implications of GST one needs to be really be mindful of when we are doing this sort of a project on leasehold land. Go down to the next. Now, if it's a commercial development is absolutely killer, because commercial development is not to the extent of post OC sale, is not tax efficient. Neither there is likely to be a huge accumulation of a credit, which will also get into the overall scheme of things. Go down next. So commercial, first of all, there is no exemption available, because exemption is available only for residential project. Residential project exemption is there. Commercial development, no exemption available. You will end up paying value of similar apartments under reverse charge mechanism by the developer, and it is available as a credit to the extent of what you sell pre-OC. Similarly, whatever you give it back to the landowner, you will be required to pay a 12% GST, which is in turn taken them as a credit to them, and they in turn can charge 12% to the customer. So the commercial development, to the extent of pre-OC sale, it's a big cost element, which you end up paying a huge GST on the development rights, plus all the construction costs which is going into the development of commercial project will get impacted. Now, go to the next slide. The most inefficient and the most danger in terms of the tax cost is the lease model of a commercial development. Because in lease model of a commercial development, go down there where first of all you give, so let's look at the transaction first. Here is the landowner. Landowner in turn is effectively transferring development rights to a developer. Developer is giving these offices on lease on a commercial offices. Developer in turn giving non-monetary consideration to constructed apartments in the form of area. And this landowner again in turn giving this on lease of offices to tenants. Now, as soon as you would look at it, this as a leasing transaction, we all know that it will be liable to 18% GST with no corresponding credit being available. So go back, Gaurav, earlier slide. where you will find this entire transaction, entire transfer of development rights will be taxed at 18% GST of the value of these apartments. Okay, and with zero credit available or credit available only to the extent of these apartments which have been given. So there is somebody is there who needs to keep on mute. Okay, sir. Okay, so developer is effectively, when they are selling it to a landowner, only to that extent you are entitled for a credit. Rest everything will be not available to you as a credit at all, because all of this transfer of development rights will be liable to GST, and in turn, because you are not selling, you are giving this on a lease. Everything which is getting in here for construction is becoming a cost. And because we have seen, of course, we have one judgment of Safari Retreat, which has reached to a Supreme Court. If that is held in favorable of SSC, this credit will be available. But as we speak today on a strict reading of 17.5, there may not be possibility to avail this as a credit, and therefore one needs to be careful about in case of a lease transaction. And it is absolutely problematic, because this 12% also what you are charging it to landowner on a construction, and in turn he is giving on lease of commercial offices, that also is not available as a credit to landowner, and it will become a double cost. So developer will end up having this 18% GST, this 12% GST, and what is going into construction of this apartment, again 18% GST, only to the extent of what is leased offices. And therefore it will become absolutely unviable in case of a commercial leasing under the JDA model. We need to structure it right. There are certain thoughts, how do we really optimize this, what sort of a transaction that we need to do. But leasing of a commercial apartment under the JDA is one of the most tax inefficient, and there have been a lot of taxes which are applicable in this sort of a transaction when we talk about a JDA for the commercial development. Go down. And this is what we have shown, that cost is really going up to 6 crore rupees when you are getting into a lease of the transaction. Now, next slides that we have got, we have left with a 10 minutes, and then we have question and answer, but I will try and wind up in 10 minutes. Then we have a society redevelopment, another important development model that we have got, where society transfers the development rights to a developer, and then in turn developer transfers non-monetary construction consideration in the form of constructed units to a society, and then developer sells the sellable units pre-OC and post-OC. Again, it is a problematic. The first and foremost issue comes up that when the society is transferring this to a developer, is there effectively GST which is payable in the first place? Is there a GST which is payable? The reason being that is the society is considered to be doing this in the course of business. See, all of these individual members who are staying in the society, individual members are effectively giving the development rights to a developer. Therefore, and society is merely acting like a conduit to transfer that to a developer. So one interpretation is that this is not been done in the course of business, therefore no GST should be applicable. However, we have seen that many societies are actually registered under GST. Societies are considered to be carrying on as a business activity when they do it something for the members. Therefore, one issue which comes up, that this may be considered as transfer of development rights in the course of business and liable to GST. We need to be absolutely careful about in this transaction when we get into a society redevelopment of this. Now, when we are giving the constructed units back, there is a GST applicable at a 5% or a 1%. Let's therefore look at it. Therefore, if the transfer of development rights, if applicable, if it is considered to be in the course of business, then there is a conditional exemption, 18% value again the similar flats, and the credit is not available at all to the developer because in turn you are paying 5% GST. As far as the area provided to society, it is liable to 5% of a market value, and that is another killer because this 5% is definitely be a cost in the system, and will not be available as a credit in relation to this activity. Their value of similar apartments sold to nearest to transfer of development rights, again that will be the value and it will become a cost in the system. Now go down. We have put some example again, taking back on the same example. 30,000 area, 60% happens to be giving it to the, assuming to a society. 60% is going to society and only 40% is remaining with the developer. This is a peculiar case and other factors remaining the same. Go down, you will find that in this sort of a cases, the GST cost is literally so high of 4.71 crore rupees. So what is left, go up, Gaurav. What is left with the developer is only 12,000 square feet. What is selling, it's assuming 20,000 square feet. So it's 24 crore rupees or so. And in that 24 crore rupees, go down, you find that GST cost is 4.71 crores. In 24 crore rupees of a GST or a sale price that developer earns, 4.71 crores is like almost a 20% is the GST cost, which is not available as a credit to anybody, and it is effectively a non-starter. None of these projects become remaining viable in this sort of a model, and therefore there are a lot of other alternate models which have been developed in case of a society redevelopment. Go down, where there are a model like self-redevelopment which is also developed. Go down, where you would have self-redevelopment where society develops this, or instead of redevelopment by the builder, and we will have to have various comparative analysis. Is it workable? We also need to examine income tax implication on those transactions and a stamp duty transaction, and look at it whether self-redevelopment is a model which may be workable to avoid this 20% of a GST cost or some part of that cost as a GST. Go down next. Then we have an SRA project. SRA is almost the same, while there are a lot of other repercussion which may be there, where additional FSI, then we give rehab building, then we give to slum dwellers where there is a member society, then we sell it to new buyer and there is a vendor contractor. If you look at it in this case, the transfer of development rights not applicable because it is given by an SRA. An SRA is not a governmental authority as such, and therefore there is an exemption provided under 243W of the Constitution, and therefore there may not be GST applicable whenever the development rights are given by SRA authority to the developer. But area provided to SRA, which is a slum development, there may be liable to 5% and 1% depending upon the area, depending upon the market price, and also what is the constituents of the project is. Is the 50% or above, is there something which one can look at it, and we will end up paying GST on that as well. Go down. Development manager model is outdated model according to us. It is definitely not a model that one should look at it, because we would end up paying 18% GST on all the consideration that is received by a developer, and this GST cost in the similar sort of a value goes up to 8 crore rupees. Definitely not a suggested model, because it has lot of contact, lot of sort of a inbuilt cost element in the GST thing, which effectively will not be available as GST cost is concerned. But this is all on the development model. It is very important that we can't end the presentation before the lot of action initiatives taken by MCHI, CREDAI National, CREDAI Maharashtra, and lot of thoughts and representations have been made to the government authorities. As Sunny was saying, we met with at least 6 states finance minister and brought to this notice that this sort of a tax regime is definitely not workable for the real estate sector, and please address this issue. So what are the issues that we have taken as we speak today, which is National CREDAI and CREDAI-MCHI? Go down. First thing that we have taken is the first one, that the GST rate itself should go down from 12% to 8%, and it has been given as an option to a developer that they can take as an ITC, or they can go for a 5%, whichever is convenient to them. You can't effectively push only one way of taxing the real estate sector. The way we have presented this also, go down. We have done the calculation where, assuming I am selling a flat of a 1 lakh, value of land is 33%, so 67,000, 5 lakhs GST. Cost of construction 9 lakhs GST. So 14 lakhs in a cost of 1 crore rupees is at 20%, because all of this cost, if you add total tax plus what is been paid on output side, which is 5% on 1 lakh, that becomes a 14 plus 5, so 19, 20.9% GST cost. In about that, we pay stamp duty of 5 to 6%. Therefore, in our country, buying a house is like a 28% tax. It's like a luxury, which is what you are effectively taxing, and therefore this is not a model which is sustainable. We have brought to their notice very actively, aggressively, and they are looking at this hopefully positively. They should look at it. Next, we have taken another important sale of a commercial property, as we thought it should be aligned with either residential. They should get the 5% benefit, or if not, at least make it a more creditable, make the GST rate to 12 to 8, so that that becomes a more viable project when it comes to commercial property. Next, the third point that we have taken is definition of affordable housing. It does not really make sense in a cities like Mumbai and all, where 60 square meter, nobody effectively gets this 45 lakhs, and it is becoming a redundant scheme for the areas like Mumbai and Pune and other metro cities. And therefore this needs to be changed. This 45 lakhs limit should really need to go up. Even if you remain 60 square meter, but the limit should really go up. Otherwise, this is not really making sense. Next, the GST on TDR and long-term lease. Very clearly, long-term lease is something which is nothing but a sale of a land. How can you tax those transactions? Effectively, TDR also, development rights. Why are you taxing those when it comes to a reverse charge basis, also to the extent of post OC? Because this is again another transaction becoming unviable. We have brought to this notice as well. Next representation we have filed, go down, is the redevelopment and SRA project. As we have seen, it is absolutely unviable to carry out a redevelopment in the current scheme of things. And moreover, when we have so many buildings which are really at a danger stage today, which may effectively get collapse, and it is a dire need to do the reconstruction of these buildings. It is becoming unviable because of the GST, where 20-30% is the GST cost which is remaining in the system. Therefore, it should definitely be eliminated, and there should be reconsideration of the SRA and redevelopment projects for the purpose of GST. Next, we have also taken another credit restriction on commercial development for lease that should be removed, 17.5. We should have an immovable property also. It is to be given separately, and non-credit leads to cascading effect of GST, and that should also be granted as part of a development of a commercial for the purpose of GST as well. Because there is no logic. I end up paying tax on lease rental that I get. Why are we denying the credit on an input side when I'm paying tax on an output side? This also we have taken up as part of the reliefs. There are another important thing that we have taken up is anti-profiteering. We have seen that many of us have got the notices from anti-profiteering, where the anti-profiteering DGAP or NAA is not able to look at the transaction in a different sphere. No methodology is prescribed. They are not considering the entire period of a project. The way they are calculating the profiteering amount is definitely not a logical one, because what credit I was taking pre, what credit I am taking post, what is I need to reverse at the time of OC, all of this needs to be considered nicely. We all know that we have done at TLP more than 15 matters for real estate sector. All of them have ultimately landed in the High Court, unfortunately, because the way they have calculated the real estate sector and the calculation is definitely not a viable way of doing it. And we have hopefully we get some relief in the High Court eventually. And we have made that as a representation also, that they should make the methodology should be prescribed, where for determination of this profiteering for the sector as well. Go down. Next slide. So very important that all of this we have taken up. I would now request Harsh and Gaurav to address any questions that the participants may have. But as a matter of fact, there are a lot of GST issues. One needs to be looked at it. There are also avenues and opportunities to reduce the impact of GST. One needs to look at it very minutely and effectively start looking at it in that context. I would request now Harsh and Gaurav to take one after the other questions. We have some questions in a question and answer session panel. Let's take up that and we can start addressing one after the other.
So I think Harsh, people have put down their questions in the Q&A box. So do you want to take it up from there?
Yes, Sunny will do that. While the presentation was going on also, between Gaurav and me, we've tried to look at some of the questions which were already posed. While to be honest, I had mentioned at the beginning of the session that a lot of questions were answered in the course of the presentation, but some of the queries that we saw which were common, I'll just take up those, and then Gaurav, you can take up some, and maybe I can also take up some.
Sure.
So the question, for example, it's come either in the chat or in the Q&A as to whether the area which is allotted to the landowner, whether that is also to be considered for the purpose of unsold area at the time of receipt of OC. The answer to that ideally would be no, because what we need to note is in an area share arrangement, when the area is given by the promoter to the landowner, at that very stage itself, the GST needs to be discharged. And therefore, for the purpose of determining the unsold area, for deciding what is the value or the area on the basis of which you need to do a reversal or pay on the development rights, in that situation, that area should not be considered. So that's a question that has come across, I think, the presentation at various portions. Unsold area, therefore, will typically consist of only the area which is belonging to the developer promoter. There was a question effectively again on whether the rates that are provided, the GST rates are on the carpet area or the sellable area. Well, the GST rates are actually to be applied on the value of the units, and therefore what is the amount on which, or the amount that the service provider is recovering, whether it is basis the carpet area or whether it is the sellable area, ideally will not matter. There was another question on, where if there is a transfer of rights from one developer to another developer, whether the new developer can go for the 1% scheme. I think the 1% scheme needs to be examined effectively at a project level. If the project is fulfilling the conditions, for example, like an affordable housing, or for example, the Pradhan Mantri Awas Yojana that we discussed. In those situations, the 1% benefit ideally may be available, should not really matter whether it is a situation of a developer 1 or a developer 2. One more question, Gaurav, before I just hand it over to you to take up some of the questions, was just asking for the decision which was in the context of the commercial leasing. The name of the decision is Safari Retreats. It is currently at the Supreme Court. While one may choose to take advantage or give reference to that, there are also several other aspects such as the time limits, etc., for the purpose of taking a credit or for the purpose of claiming a refund. That is also something that one needs to keep in consideration and not only look at the Safari Retreats. Gaurav, sorry, but just last one on one question, which is on if you have a pure labor contractor and overall, let's say the situation is that it is less than 50% or more than 50% area is less than 45 lakhs, whether the benefit of a lower rate would be available. The answer to that is no, because that benefit is provided only in the situation of a works contract, and a pure labor would not fulfill that. However, there could be some structuring options because there is a concept of composite service providers as well under GST, in which situation they are required to charge tax at a rate which is lower than the 18% rate. So that's how a potential mitigation option could arise depending on the facts. Gaurav, you want to just take up some more questions which are in the Q&A?
Yeah, Harsh, thank you so much. So, of course, I guess most of the important questions which were addressed by Rohit, and of course, you have taken up some of the key questions. So, yes, of course, I also wanted to say about that composite supply. But yeah, one thing which is important is that please understand there's a question whether the landowner can avail the credit. Two important things to note is, yes, landowner promoter will be allowed to avail the credit, but those are the two conditions where he will be able to avail the credit. First, he should be making the sales pre-OC, and that the landowner promoter definition is restricted to residential development. So if it is not a residential development, then even if you are making pre-OC, you will not be eligible to avail the credit. And secondly, if it's a residential development and you're selling pre-OC, yes, you are eligible to avail the credit. In fact, just giving a reference to what Rohit was telling, that there's a welcome move. Now you can raise an invoice, prior to the OC date so that he can avail the credit and pay through this, and there's an accumulation of the credit at the time of OC to discharge. Okay, of course there is that. Okay, what is the time of supply for transfer of development rights for commercial construction? Please understand, see the there's a variation which needs to be understood, that if in a commercial development we are going for an area share, the point of time of supply continue to be the date of receipt of OC for the project. But if it's not a constructed area and you are handing over revenue share, then in the case of a revenue share, it's an important to note that the time of supply will be the date of transfer of development right. So if you are into a JD arrangement or a society redevelopment where you are taking up a construction of a commercial construction, and you are actually in a revenue share agreement with the landowner or the society, please understand, in that is the only scenario where the time of supply or your time of payment will be the date on which you have actually executed the development arrangement and not the date of OC. Mixed development, of course, what is the ITC can avail? I guess proportionate ITC will be eligible and available to you. So I don't think that is an important thing that you can always take care of. Okay, I just received one important aspect. Payable in the year obtaining can be discharged GST and available cash. I guess this is now clear.
Gaurav, just adding, while you look at some of the other questions, there's a question on what is the status of the Vasanta Green's case. The Vasanta Green case, as somebody has mentioned, the impact, it's an argument effectively taken. For example, in a redevelopment, while that is in the context of a villa, the whole argument is effectively saying that since the costs of the units that are handed over is included in my sale price to the final customer, which is effectively from a commercial perspective, that's the revenue that a developer typically earns. Therefore, and since that revenue suffers a tax, whatever are the costs incurred in the course of earning that revenue should not be subjected to tax. That's effectively the Vasanta Green's case, a good argument that somebody could consider in the case of a litigation. The case is right now at the Supreme Court. It has not yet attained finality, and we need to ideally see how how the matter progresses further at the Supreme Court.
See, there are two important things, I guess. Again, there is a lot of confusion which I realized while going through the queries about the credit eligibility of a landowner and availment of credit for payment of a, let's say, one of the questions which we have received, that if it's a 100% commercial JDA, as we have explained that even if it's a 100% commercial JDA, but if it's a lease model and you are letting it out, that though only to the extent of area you are intent to sell, you will be eligible to avail the credit. Otherwise, the credit is not available to you. Another important and interesting question is about what will be happening on the construction cost of the area to the existing tenants. Please, whether it's a member or tenants, the tenants will also be under, let's say if we are talking about our property like a cess property under 33(7) or under 33(10), those cess properties where we have a tenanted tenants also, under those kind of properties also, the implications will be identical to the implications which we have understood in respect of the society. So there is no change in that. That has been clarified by mode of FAQs which have been published on 14th November 2019. There are 2 FAQs being issued, and then they have clearly provided that yes, and even in the case of tenants and SRA projects, you will be required to discharge GST on the constructed units handed over to these tenants, because at the end of the day, these are in lieu of transfer development rights. Yeah, Harsh, please, if you have anything else, this you can find out.
One issue coming up. Alembic is again pending in Supreme Court. Now, Alembic is pending in High Court, which is in the context of ITC available or not. That is also a very positive judgment for the industry, but that is pending in High Court as we speak today. There is also, please appreciate, there is no concept of sellable area remain now. Everything is to be a RERA carpet, and therefore entire calculations, entire determination of tax liability is required to be done on the basis of a RERA carpet and not on the sellable of the area here. There are, of course, JDA implications or revenue share not explained. I think very important that if it's an area share, we have discussed that revenue share is only one-way transaction. the second leg of a transaction is a monetary transaction, where landowner is transferring development rights and getting a consideration in the form of money. But that transfer of development right, if it's a residential project, whatever is remaining post OC sale, to that extent, the entire consideration that you have paid in a monetary terms into that area remaining post OC into 18% is the GST which is required to be paid. If it's a commercial project, as Gaurav explained, you may need to pay upfront GST. And now you will ask me, how do I calculate that? You'll have to estimate the price, pay GST, and then as and when we start paying the rest of the consideration, you may need to pay the balance one. Therefore, there is an implication of the timing issue, but in the case of revenue share, it is not the barter transaction, it's only one-way transaction where landowner is transferring development rights for a monetary consideration. And therefore, that monetary consideration, depending upon residential or commercial, it will be liable to GST. Then there are some issues on society redevelopment. We have clarified those issues, including the existing tenants which are required to be paid. Then I don't see anything is as such remaining in the session. Harsh, Gaurav, if anything is there, we can just take up. Otherwise,
Harsh, just one thing. So you have taken up that point, na? Whether when we are considering the unsold area, the landowner area will be considered the sold area.
That's right. Yes.
Yeah. So I guess most of these.
So just one or two more questions, which we see. If it's a self redevelopment, what is the rate of GST? Self redevelopment, as Rohit had explained, would typically be appointing a contractor who would take the works contract activity for the members. In that scenario, ideally the rate would be 18%. A very interesting question, not in the Q&A but on the chat box, is about under e-auction. Apparently some land has been allotted and that land is already a developed land. So that brings us again to the question of, if it's a plot of land where development has already been done, and since this is provided by the state, what would be the implications? 2-3 points to note. This again could be a scenario of land not on as is where is basis, therefore the relevance. Second, if it's provided by the state, again, I mean, more critical to examine this transaction in detail, because a lot of services provided by the government are subjected to reverse charge mechanism. So there may still be a situation where the state government may not charge the tax, but as an SSE, you may need to examine whether there's a reverse charge mechanism that will be attracted under this transaction. We need to take note of the 2-3 advance rulings that we made a mention of in the presentation, and look at the way the contract is structured to come to a cohesive and a final conclusion on this issue. This is a gray area.
okay, so over to you, Sunny. I think we've covered most of the questions as well. Sunny, are you there?
Well, Sunny has left. He had to go for a very important meeting.
No
This is Satish Kumar here, the head secretariat from CREDAI-MCHI. Well, I think we've through with all the queries and things which members had raised. We, come to end of the session. We'd like to thank Rohit Jain for the exhaustive presentation that you had. It was quite detailed, and there was a lot of clarity in each and every issues. Of course, we understand it's not easy to cover everything in 1.5 hours. There's much more doubts and other things would be there with members. Well, most of the questions were also answered by Harsha. Thank you so much, Harsha and Gaurav Sogani, for your reply. We request we just tell all the members that shortly we would share the presentations with everyone, and of course this is not end at all. We are open. Harish, my colleague, and me, we are available at the MCHI office to put in touch with ELP. They are our partners. So any queries that you may have specific, we will put you in touch with them, and we will help you at every stage. So thank you very much for attending this session patiently, and we'll continue to do more sessions like this as and when things rises up. Thank you very much. Thank you very much.
Thank you.
Thank you.
Thank you,
Thank
everyone.
you for the.
Thank
Thank
you.
you.
Thank you.
Bye-bye.
Thank you. Thank you.